Welcome to the Beginner's Guide to Trading Forex. This is not like other beginner trading courses. This is what I wish someone had told me before I started my trading journey. You will not learn lots of technical stuff on how to trade, because I don't want you to make the mistake most beginner traders make. They spend years learning everything because they have no idea what is important. Before you learn to trade Forex, you need to know what is important. Otherwise, you could spend years spinning your wheels acquiring more and more knowledge, most of which will be irrelevant. After this course, you will know what is important and then you can choose what you learn. But the process will be much faster and more efficient. This mini course will prepare you to go learn to trade, but you will understand what your trading goals should be and how simple setups can take you to that trading goal. This simplicity has taken me years to learn. I want to save you those years in your learning curve. I wish you all the best in your trading journey. In this video, I'm going to talk about the guiding principle behind successful trading. Trading is all about the numbers. You need a mathematical formula that equals profits. So let's have a look at this. So let's say you had 20 trades and half of them were winners and half of them were losers. If you make a profit, if you have 50% or even 30% winners, then you don't need to be the best trader in the world to make money. And the way that you do that is to have winning trades that are much larger than losing trades. Now this might sound very, very basic and simple, but it's something that most traders do not do for various different reasons. But I wanted to go through the numbers here because I wanted to show you what the principle should be behind any trading system that you actually decide that you want to learn and that you want to go with. So here are a series of trades, 20 trades, and I've created the series in a way that would emulate a real life situation. So it's not just win, loss, win, loss, win, loss. It would be win, loss, win, and then a streak of 3 losses, a couple of wins, and so on, which is more like what it would be in real life trading. And I want to show you the numbers when you have a risk to reward ratio of 0.5 to 1, so that would mean that your winners are half the size of your losers. When your winners are the same size as your losers, when your winners are 3 times the size of your losers, and when the winners are 5 times the size of your losers. So let's start with when your winners are half the size of your losers. So let's say you risk $10 on each trade. And so you could see the series here. So you would win $5, you would lose $10. You would win $5, you would lose $10. You would end up at the end of 20 trades at minus $50. Now let's say you did the same thing again, but this time you had a 1-to-1 risk-reward ratio. Your reward was the same amount as your risk. You would end up with 0, and I'm keeping this simple now. I'm not taking into account any spreads, which is the fees that you pay brokers or anything like that. So just doing the basic numbers. Let's say you had 3 times the reward on a trade risked. Now you are making money with the same series of trades. After 20 trades, you would end up with $200. And if you had a bigger reward, you would end up with $400 after 20 trades risked. So this is the key thing to keep in mind when you're trading. It's the most important thing, because there are only certain things that you can actually control in trading. You can control where you enter the trade, you can control where you exit the trade, and you can control how much you risk on the trade. But what you can't control is how many trades you win and in what order you win. So you need to have a winning formula that is inside your control. So you go for the best, the highest probability trades, because of course you do want to win as many trades as possible. So you're going to go for the A grade trades. But what you're not going to do is have your profitability depend on you winning trades. Your profitability should be because you're making money, because you have a high reward compared to the amount risked on your trades. Don't take my word for this, okay? There was an article in Daily FX, which is the online sort of news website for FXCM, and this article was done on December the 7th, 2016 by David Rodriguez. And they looked through 43 million real trades to measure trader performance. And here's what they said. The majority of trades are successful, and yet traders are losing. Here is what we believe to be the #1 mistake FX traders make. So they go on to say, I mean, if you can read through it, and I'll put the link below this video. But why does the average trader lose money? We looked at over 43 million real trades, and we came to some very interesting conclusions. The first is encouraging. Traders make money most of the time, as over 50% of trades are closed out at a gain. So a 50% win rate is very, very doable. Okay. But if traders were right more than half the time, why did most lose money? And this is the key. It's the average gain versus the average loss. You can see that the average losses are much bigger than the average gain on all of the currency pairs. We can now clearly see why traders lose money despite being right more than half the time. And very, very simple. They lose more money on their losing trades than they make on their winning trades. And they go on to actually, look at it in more detail. So it says cut losses, let profits run. Why is those so difficult to do? So when your trade goes against you, close it out. Take the small loss and then try again later if appropriate. It is better to take a small loss early than a big loss later. And if a trade is in your favor, let it run. So this sounds very, very simple. But it's not simple, and the reason is human nature. So going back to what I was saying before, the reason you will make money in trading is because you have trades that have a high reward compared to the amount you risk, and that is the key indicator that will determine if you are a profitable trader. In this video, I'm going to just talk you through the platform that I use, which is MetaTrader. MetaTrader 4, they also do MetaTrader 5, but MetaTrader 4 is the most popular trading platform, and it's very, very easy to use. So when you download it, I would download a demo account and have a good play around with it and a good practice, so you become really familiar and comfortable with the platform. So how you download it, if you just go to do a search for MetaTrader 4 online, you will find that there's a lot of brokers that will allow you to use their version of MetaTrader 4. They do ask you in return for your email address and your phone number, and you may well get a call from them asking to open a live account. My suggestion is, if you do open a live account, open a micro account or a nano account. Open the account that allows you to trade the tiniest amount of money and risk the tiniest amount of money, and do that when you've got the hang of the demo platform. So it's good to trade real money because you need to get familiar with the feeling of what it's like. It's a different psychological animal to trade real money as opposed to just doing a demo platform. But the demo platform will show you how to use. It's your practice platform. You can't break anything, and it's what you need to do before you actually do your real trading. So let me just very quickly go through how you would use the platform. So what I will do first of all is I will just remove everything here, all the indicators here. Okay, now what you see first of all is that I use what's called candlesticks, and if you want to change how it appears on the screen, you can click that. That gives you bars. You can click this, which gives you a line, and you can click this, which gives you candlesticks. I use candlesticks because I just find that candlesticks are the easiest way and the most efficient way to understand what's going on in the market. Now, what a candlestick does is it actually tells you the high and the low and the open and the close of what price was doing during that period of time. So here we have daily candlesticks. Okay, so this candlestick here, so if you just move this little mouse here and you just touch the top of the candle here where it closes here, it will give you the open, which you can see was 1.2883, the high, which was 1.2939, the low, which was 1.2880, and the close, which was 1.2901. Okay, so that's all it does. So a candle, you can see at a glance where it opened, where it closed, and it gives you a visual representation of what it did that day. Now, likewise, these are the time frames, these are the different time periods. So if you went on to a month, the monthly chart, the candle would give you the open, the close, the high and the low of what it did that month. If you went on to a 5-minute chart, the candle would give you the open, the close, the high and the low of what it did in the last 5 minutes. So here, for example, is the last 5-minute candle, and here you can see is the next 5-minute candle. So these are the different time frames, and these are candles. Now, if you want to color and actually create your chart, what you do is you right click, you click on properties, and then you can choose what your color scheme is. So let's say what I do here is I choose black on white. Then you can choose the color of your candles. I tend to choose blue going up and the down going red. Okay, and that's basically how I sort of set up my candles. So now, there's lots of different things. What I want to do is I want to give you what, in my opinion, is the most efficient way to trade. So I don't want to go over a lot of things that to me are just not relevant, okay, and that they don't work. I've been through myself in the past using lots and lots of what we call indicators. I'm going to show you what indicators are, but then I'm going to basically tell you to forget them. Okay, when I first started off trading, I spent, I suppose, maybe a year playing around with indicators. So if you actually click the insert, you'll see it says indicators, and it will give you stochastic, everything. Trend indicators, oscillator indicators, volume indicators, other indicators, and custom indicators. There's a couple of indicators I use, okay, but I use them as a guide. I don't use them really to they are a help, but they are not a leader. Because, in fact, let me click one of the ones I use. This one is called an ADR indicator. What it does is it actually works out what the daily range was for the past 5 days, and it tells you what you should expect for today. So, for example, the ADR was 59 points, and today it's showing 93 points. Okay, so you can see when the ADR high and the low was hit, they formed these blue lines. Okay, so that can be useful, but it is just an indicator. It's not something to actually form your trading. It's not a magic bullet. There's nothing like that. It just doesn't exist. Okay, so this is why I'm not going to spend a lot of time on indicators. So let me give you another indicator that I use and tell you how I use it. So another indicator I use is what's called a moving average. So I use a 10 period green moving average, and I use a 3 period red moving average. Okay, now the reason I use these is to get a visual representation of how fast price is moving. Okay, so for example, when you see this moving average, which is a 3 simple period, when you see that these candles are moving up very, very fast, that tells you that there's a lot of energy in the market. And when you trade, or at least in my systems, when you trade, I want to look for a lot of energy, a lot of directional energy in the market, because I want to trade in the direction of the market energy. Okay, so that's what I use these indicators for. So they're not a magic bullet. They don't I don't go for things like, which you might see on the internet, moving average crosses or anything like that, because a moving average cross is not, in my opinion, a reliable way to trade. Because you can see here, for example, there's lots of crosses. Okay, so if you were just trying to trade lots of crosses, you'd be losing lots of money. So I don't use moving averages to trade in that way, but just to simply see how much energy is in the market. That's what I use indicators for. So another very effective way to make money in the markets is to only trade in line with the momentum on a higher time frame. So what do I mean by that? So on the one side, on the right, you will see that there is the 30-minute time frame, and on the left you'll see that there is the daily time frame. And if I go to properties, okay, and I go like that, and I put the period separators in, and I do the same for the 30-minute chart, the 30-minute charts separators have a period of time, are each showing a period of time of 1 day. So these are the 30-minute, all these 30-minute candles here, this designates 24 hours, okay? And on the daily chart, this designates a whole month, okay? So this is April, this is May, okay? And this is the 16th of May. So this 30-minute chart here is represented by what happened yesterday. So what we can see is, if I go here and I start drawing some lines here on the daily chart, I can see that price is actually moving sideways on the daily chart, and that there isn't really momentum because price is crossing over. Okay, and in fact it's forming something that is called, what we call support and resistance. So horizontal support and resistance, if I draw that in here, this is what we call when price moves up and it hits a certain level and it bangs up against it, and then and it kind of moves away and doesn't go through it, we call that resistance. And this is, if I put that there, you can see how these candles, this candle banged against it and closed below it on the daily chart. This candle here opened there, and then the next daily candle tried to go through it and it couldn't, and basically it didn't actually go through it till days later. So because we see all these candles moving sideways, not able to go through this level, we know that this is what we call a resistance level. And then what often happens is you'll find that the candles will move back, they will hit that resistance level and they will sit on top of it. So if you think of the resistance level as like a ceiling and you're banging your head on a ceiling, and it then forms the seat of a chair, and price comes and sits on the chair or rather maybe a floor, comes and stands on the floor. And so this resistance now becomes the floor, the support that price can sit on, okay? And this is also important information when you are deciding about where the momentum is likely to go and how much momentum there is in the market. So we can see that these daily candles for basically the whole of May have just been moving sideways. And so that is going to make us, so when we do our trading on the lower time frames here, if we see what's happening here and we start putting in our, see there is another level there you can see of resistance, okay, that is if we actually put those levels in to our 30-minute time frame, okay, which is probably about there, 1.29462, 1.29462, okay, that provides us with a good place to know where we're going to take our 7.1. It's nearly there, so we'll just put it down to 6.2, somewhere like that. Okay, so that provides us with a good place to take profits from. Okay, so what we're doing is we're overlaying these higher time frame levels, higher time frame support and resistance levels and trend lines. Let me color these green. I always color green for my daily trend lines and support and resistance. So we color those green, and then what we can do is we can overlay them. If I now go down to the 30-minute chart here, this daily chart, okay, all right, so I can now see the daily support and resistance on this chart, and I can now overlay the 30-minute trend lines. Okay, so I can now see this 30-minute chart, this 30-minute pattern in the context of a daily pattern, okay, in context of the daily support and resistance. And that gives me more information to know where the energy of the market is likely to be. Okay, so but what this also tells me, if I go back to the daily chart, is that there's not a lot of momentum in the market. Because the momentum, if you remember in an earlier video, I talked about how I use this moving average. Here's the momentum on the pound US dollar, and because this fast moving average is moving very, very fast, and the candles are exceeding the moving average. So really, that's where I want to look for trades. But here, the price is moving sideways. So the only sort of trades I would want to take here are these sort of sideways small moves. I'm not going to take big moves in the market. Now, that's not to say that you couldn't take trades during this time, because you certainly can, okay, but you would only be taking very short-term trades, 20 or 30-point moves. Let's see how much there is there. Oh, well, this is a 70-point move, but you would only be taking small moves because you know that, looking here, that price is moving sideways between these two levels of resistance. And in fact, there is another level here. Okay, you can see here that price on the daily chart has been moving between these areas. So this only actually gives you an area of about 58 points on the daily chart. So you will only, so that gives you a lot less than, for example, a lot less momentum and a lot less leeway than these sort of candles here, which are moving up strongly. Okay, so what you would want to do is actually go and look for what's happening here, for example. So let's go here. So you can see here now that price is moving with a lot of momentum, that the candles are big. There is still a pattern in the market. If I draw this pattern, okay, we're now on the euro US dollar. We now have a widening pattern, Okay, and the reason why patterns work, to be honest, I don't know why they work, and I don't think anybody could tell you really why they work. The only thing I would tell you is that there's an expectation. I think they probably work because they are easy to see and they are predictable, and traders look for predictability in the market. And the big traders, this is what they look at. They look at things like patterns and trend line breaks and breaks of support and resistance. So these very simple patterns tend to work very well. I told you I was going to make things very simple for you, and you don't really need to understand why they work, because I don't think anybody really does understand why they work. The key thing is to actually know that simple patterns, simple breaks, things like breaks of big round numbers, things like that, those are the things that work in the market. You don't need anything complicated. You don't need any complicated indicators or anything like that. Simple patterns and lines are enough in the market. Okay, but what you do need to know are where is the energy in the market, where's the momentum. Okay, and so these simple patterns, by using these multiple time frames, that's where you can find your opportunities in the market. So here, for example, we didn't know that these 2 days here, we didn't know, if we go back, all right, we didn't know after this candle what price was going to do next. All right, but the thing is, we could see by doing these 2 lines here that a megaphone channel had formed. So seeing as we know that a megaphone channel has formed, we expect that the next thing, is that price is going to bounce off this trend line here and is going to go in a certain direction, which is up. It's predictable. All right. And, when you can see that there's these multiple candles here. It didn't actually form a third bounce, really, but there was a lot of candles here which formed this first bounce. It wasn't just a one candle bounce like this. So there was a lot of evidence that this diagonal line had a lot of strength to it. Okay, and likewise price bounced off this diagonal line here very, very smartly. So this is how you form these patterns. So this, we know before it happens that this is an area with an opportunity to go long. And then what we do, when I say go long, I mean go up in the market. And so then what we do is we go over to the lower time frame, and we're now looking for ways to enter into that move. Okay, so if I just put those lines in, so actually there's in fact I won't go there, I'll just do this one here. Okay, if I go back down to the 30-minute chart, okay, so what we've seen now is, so on the 30-minute chart, all right, we would be looking for opportunities to get into this move. And when you look at the 30-minute chart, you can see some really good opportunities, because we see what are called these sideways areas of support and resistance. Okay, so I'm going to go back to this orange line here. And what happens here is that price has moved sideways, and it's formed this sort of coiled up energy. And so you can see here that price starts to move here. Okay, it hits this area here, forms this sideways move, and then it starts to, after the weekend, these 2 lines here stand for the weekend, starts to again form this area, confirm this sort of area here of resistance, this sideways move, and then it breaks through with a big candle at about well, we'll say 6 a.m. in the morning, but I think this is actually 1 hour ahead. It's about 5 o'clock in the morning, 5 to 6 a.m. in the morning. Price bursts through this level here. And this is when, you know, we're expecting this. We're expecting this to happen. We've already seen this set up on the daily chart. And this is where we start to look for opportunities, low risk opportunities to get into this move. Now, if I just overlay this with a moving average, with the two moving averages to measure momentum. Okay, let's just do that. Right, well, let me come back to this in a second in the next video. So when I come back to this, what you can see now is what I was talking about before, is you can now see how price starts to move with momentum on these 30-minute charts within here. Okay, so this is what it looks like on the daily. This is what it looks like on the 30-minute chart. And so here are great opportunities to find entries into this move. And what you can do is, let's say for example we had an entry over here. Okay, let's say that was our entry. Then what this does is it gives us an entry. Let's say we entered here and we had a stop loss below a previous level, or below two previous levels of support here. Okay, so let's say we had an entry there and we put a stop loss there. So we can see here the middle number there, it says 187. It's actually 18. So that's 18.9. So the stop loss would be about 18.9 pips plus the spread which you pay on the euro dollar, which is probably about 1.5 to 2 pips. So that's a stop loss of about 20 pips. Now, if you don't know what a stop loss is, basically it's an order you put there where if price moves against you, then it will protect you from losing all the money in your account. So you will actually lose 20 points. So if I put a stop loss there, if I was going to trade, went on that breakout and I put a little stop loss there, I'm going to indicate it there, okay, then if price turned around on me and hit that stop loss, I would be out of the trade, okay. So, but if let's say that, but as you could see, that doesn't happen, and that's the reason we look for these sort of setups with a lot of momentum, because we don't want that to happen, okay. And if you find a lot of momentum in the markets, that makes it less likely that it is going to happen. But so we could get into a trade that has a 20 pip stop loss, okay, at around the 1.09399 level. So let me put that in there. Okay, so now what you can see here is that if you put this level that's here onto this pattern, this daily chart, we already know, or we already believe, that price is going to move towards the other side of this megaphone channel, okay? So this potentially, we can see in advance, has a potential of about 123 pips for a 20 pip stop loss. So our choice is that we could either take, which is about a 1 to 6 ROI. So we can either sort of just follow, we have the choice of either just taking our profits sort of near the top here when price starts to move sideways, which would be a, well, that's not a very big amount. That's like 37, that can't be right, hold on. 20, yeah, so that's about a 1.5 ROI, which is not very big in my opinion. I like to go for a bigger amount than that. Or what we can do is we can, when price moves away from us, we can move our stop loss to break even. So we move our stop loss up to the entry, okay, and then what we do is we wait for price to move towards this area here and we take our profits then, which is what I would recommend. And the reason we do that is because we want to make the most of these trades when they come along, because it's the profits on these what I call high ROI trades, high return on investment trades, that are going to make up for the times when you take trades and they do turn around on you and you lose money. Because what's important to know is you will not win every trade. You do everything you can to make sure that you have a good trade, that you are likely to win on it, but you won't win on it. You know, a lot, not a lot of trades, depending on what systems you use, but you will lose a proportion of trades. And so by always aiming big, thinking big in your trades, you know, which is low risk trades with a high reward, these trades are the trades that will make up for the losses that you've had, and they will also give you profits. Okay, so that's why I always recommend to go for low risk, high reward trades. And so this is the foundation of the courses that I teach, which is to find ways of finding this high return momentum in the market using the daily charts or the 4-hourly charts, the weekly charts, the monthly charts, the higher time frame charts. You find where price is going to start moving with momentum, and then what you do is you go down to the lower time frames and you find ways of entering the market with a low risk entry, and you go for a high reward. So all my systems, my trading systems, are all based off that principle, is to find these low risk, high reward entries into the daily or 4-hourly or monthly momentum, so that you will make a profit overall on your trades. So what is the most effective way, or the most effective things you can do to make money in the market? Because that really, as a beginner, that's really what you want to know. It's very, very easy to get caught up in a lot of different things. There's a massive information out there, okay? And you know, it's how do you put all that information together to come up with a way of making money trading Forex? That's the only question. And you could waste years of your life in looking for what's called the holy grail of trading. But what I want to do is actually give you some shortcuts to that and make things very, very simple, okay? So one of the most effective ways to make money in the market is what I call patterns. And well, I don't call them patterns, they are patterns, chart patterns, okay? Because what you can see when you just look here is you can see that price is going up and down, up and down, up and down, okay? And so how do you make sense of price going up and down? Well, what we do is we start drawing lines. So for example, if I do a line across there, you'll see that price actually came up and it hit it, okay? And it hit it and then it bounced straight off it. If I do, let's find another one. If I do a line there, okay, and a line there, what we can see is that there is a channel beginning, okay? So without knowing anything, if I look into the future, okay, and I actually go onto shapes and I put a little rectangle somewhere here, and I put a little rectangle somewhere here, okay, what this tells us is that price, if it hits there, somewhere there, okay, it's going to be the third bounce off what we call a trend line. And if price hits here, it's going to be the third bounce off this lower trend line here, because it looks as if price is forming another channel. And channels and are patterns that you will find everywhere, okay? So here is another channel. Okay, this is a widening channel and it's known as a megaphone channel. Okay, so price started there, bounce 1, bounce 2, bounce 3, so bounce 2 on the upper line. Then it came down here, but it missed, it couldn't hit this couldn't hit this lower line there, so the pattern started to change, started to move, went back up there, bounced again off this trend line, and then the trend line failed, and you could see it started making another pattern. Okay, and that's what price tends to do a lot. It tends to form these channel-like patterns. Okay, going sort of bouncing up and down, up and down, up and down, and then basically they fail and they start forming other patterns. Let's do another one here. Okay, so you can see there's another channel, up and down, sideways move, then the pattern fails, and then it forms another up and down, sideways move. And then in between that, every so often, you'll get a huge move up or a huge move down, but most of the time, okay, you will see these patterns forming. And if you can shrink out the chart, if you sort of click here, this shrinks out the chart, it makes these patterns very, very clear. Now, why are these so powerful? They're powerful because there is an element of predictability, okay? And I say an element, it doesn't mean they definitely will, but it is it does give you an idea of where price is going to go next. And if you have an idea of where price is going to go next, then you can actually have a basis on which to trade. So for example, here is a pattern here, okay? I know that's a pattern probably like from here, for example, I can see that there is a little bounce there. There's a third bounce there, okay? So I can know the bottom line. I don't know the top line, but I know this line here. So if I'm just trading, let's say, waiting for the next bounce off this line here, I pretty much know that it's going to bounce when it hits here, or even if I don't know it's going to bounce, I've got a place to look for a bounce, okay? And then by the time it hits this second bounce at the top here, I've now got a second top line. So I can predict in advance that price can go here, and that if I was going to trade long, I would take my profits here. Okay, and so this is what patterns do, is patterns give you predictability in the markets. In this video, I'm going to now put those two things together to show you how using top-down trading by analysing the higher time frame and then going down to the lower time frame to find good trades that you can enter that will give you a high ROI trade is actually very, very simple. And the reason I'm doing this again is because I want you to realize that actually trading can be quite simple, but what's most important to bear in mind is the principle behind the trading, which is going for high reward trades. So if I take this chart here on the daily chart, let me just shrink it out a bit. And what we want to look for are good patterns on the daily chart. So we want to find where are the areas of energy likely to be on the daily chart. Well, the first thing is, in fact, let me just do this. The first thing is, when you shrink out the monthly chart, is that there is a level here which is a very powerful level. This is called a resistance level, a monthly resistance level. And what you can see is that when price reached this level, which was about the 124 area, it reversed very strongly back in 2006. I think it was 2006, 2007. Okay, 2007. And it hit that area again in 2015, dropped down significantly, and now price has pulled back and hit another level of monthly resistance. Okay, so if I just go through here, if I just enlarge this a bit, you can see that what we've got here is what is known as a resistance zone because this is where candles are closing and where they're spiking down to. So this has actually created a little zone. Price pulled back up to this zone back in at the end of 2016 and reversed from the zone and is now making its way down. We don't know what it's going to do next, but what we do now understand is what's happening on the monthly charts. This gives us a context to understand what's happening with our trades. So when we go down to the daily chart, we can see all the monthly lines, and we can now understand why the daily chart is behaving as it is. So let's draw in some daily lines to see where the daily energy is. Okay, so if I just put these here, this is called a trend line, and what you can see here, if I just bring it down a bit, okay, is that this has actually created a megaphone channel. I've drawn it a bit roughly here. And what I do is I colour the lines different colours so that I know the difference at a glance between what is a daily line, what is a monthly line, what is a 30-minute line, and I can see it all on one chart and it's very clear. So these are now my daily lines. Okay, so this is the area that we're interested in, okay, which is where, now you can see actually when we start to make it larger that actually these trend lines are more fanned out, that this is the outer trend line here and there's a little inner trend line here as well, okay? But I don't want to confuse you about that, so I'm just going to remove the inner trend line. That's not important for what you're learning at the moment. So we can see that price hit this trend line, and if we hadn't known that, let's say we were looking at this, okay, because remember this is all about being able to predict the future. We can't really predict the future, but we can look for where potential areas of energy will be, okay, where potential areas of diagonal or horizontal support or resistance will be, and we can make a prediction about what price will do on the basis of probability. And so when we move forward, because we know, for example, that price has been bouncing off this lower diagonal trend line, we can predict that if price hits this lower diagonal trend line, it is a place of energy, high energy. It will either break through or it will bounce and it will go back up again here. And if it goes back up again here, which it does, this is an area that we could look for a trade, what's called an upward, a long trade. Likewise, we know that if price hits the opposite side here, there's going to be a lot of energy in that move and it will either break through or it will carry on down. But we know that the overall energy is down because we've got an area here of very strong monthly resistance. So we're looking now for a short trade, and we know this by the time price hits here. We know that. We don't want to get involved if price breaks through, but we want to see if price goes down, that's what we're getting prepared for, okay? So this is how you are already looking into the future by going on the higher time frames. And then, in fact, if I actually now just go down to the 30-minute time frame, this can actually make it easier. So we can see what's happening on the daily chart. Okay, so now what we want to do is put our channels in place, our 30-minute channels, to actually find ways to enter into this move to get these high ROI trades. So now what I'm going to do is I'm actually going to use an orange color, which represents 30 minutes or hourly. So I use orange for that. And we can see that on the 15th and 16th of May, we started getting this megaphone channel. Okay, and there was a key area, a key moment here, which happened on the 12 o'clock on the 16th of May. If I put a little shape there, okay, and it was the third bounce off this upper trend line, and it was a widening pattern. And if we had found a good entry here, which we could have done, because we know, if I just move this down a bit, we know that because of you know, the area of probability, because price makes these patterns, we are looking for an entry to go short into the move, to go down into the move, and then what we want to do is put a stop loss on and hold on to the move to get a very good risk reward. So if we had entered, let's say, and got an entry of, let's say, 25, a risk of, let's say, 25 points on the move, at this point would be, well, at this area here, we would have been down to, you know, we would have got a 1 to 10 ROI on the move, which is actually what I teach in my trading course, the 10 times ROI system, which is part of the high ROI trading course, which teaches you all these things. So that's it, but that is just putting two very, very simple things together, which is using the higher time frames to drill down and to find out, to predict what's going to happen in the future, and then looking for opportunities, very low risk opportunities on the lower time frame, and high probability opportunities because you have the daily or the monthly energy behind you, so it's more likely that price is going to move with momentum and force in that direction. By combining those two things together, you can achieve your goal, which is to get high return on investment trades. In this video, I just want to talk about the next steps that I recommend that you take after this system. So you will know from watching the previous videos that what I recommend is that you always go for a very high return on your trades. Now there's a number of ways to do that, and one is to find very low risk trades in the sense that you have a very small stop loss to a very high return. And you will find those trades in my systems, the 10 times ROI trading system, and I have a blog of that name, 10 times ROI trading system.com, and I highly recommend you go and visit that blog because there's a lot of free information on that blog, a lot of free videos. So if you scroll down, you will see a lot of videos. There's 37 pages of free videos there. Okay, lots and lots of videos, free videos for you to watch. Okay, I also recommend that, obviously I'm recommending, but it's up to you of course. If you're interested in my ebooks, then head on over to the ebook page where you can get some good deals on the price of my books. I also do video courses, so you can head over to there. There's a swing trader course, day trader course, end of day trading course, and also trading psychology course. So, you know, a very comprehensive package for you to be able to go to the next steps if you are interested in high ROI trading. And it's not just about getting a small stop loss and a big return. There's other ways to increase the amount of return you get on a trade. For example, part of my high ROI trading course, I talk about pyramiding. So it actually teaches you how to pyramid your way to up to a 1 to 30 ROI on your trades, or even higher. So by learning how to pyramid into your trades, you can increase the ROI on a trade dramatically. The other way to increase the ROI on your trades is to learn inventive money management techniques. These are also covered in my books. So that would be my next step for you. But in the first instance, if you go over to the blog, as I said, there's lots and lots of free resources. Now the other thing is that you can go over to my Trader Self-Control blog, where you can also get the ebooks. You could also pick up a copy of a trading journal that I've created, and it's very, very important for you to take control of your trading psychology, because in order to be a successful trader, there's two sides. There's the things that you do and the things that you think. And if you don't get both of those in sync, you cannot succeed in trading. So just as important as the trading system that you have is taking control of your trading psychology. Now, if you're a very beginner trader, you won't believe that. And because all that will seem important to you is getting a trading system. You will have absolute faith in your ability to execute that trading system as long as you find a winning system. But here's where the cycle of doom begins for traders, and why traders don't succeed is because they find winning systems. So they will find a high ROI system like the 10 times ROI system or any other system. They'll try it out. The system won't work for them. They won't realize that the reason that the system isn't working for them is because they haven't got their trading psychology right. They will blame the system and they will do something called system hop. They will move on to the next bright shiny object system. That system won't work. They'll move on to the next system. All the while they'll be looking outside themselves for the answer. You can waste years doing that. A lot of traders do. It's called the search for the Holy Grail. It's a very common phenomenon in trading, and the reason that happens is because the traders do not get their trading psychology right, which is why I created these books. And if you head on over to Amazon and have a look at the reviews, you'll see that I get some amazing reviews for the books, because they are very practical short books to deal with the problems of trading psychology and trading. So can't overemphasize it. I know it's very tempting not to bother about trading psychology. You didn't get into this game for self-improvement. You got into it to be, make money. I understand that. But unfortunately, if you're not interested in self-improvement, I completely get that. But that is the price you pay to become a successful trader. A successful trader has to become a master of their own trading psychology. And these little books help you to do that. And for a very, very reasonable price. So I can't emphasize that enough. Head on over to the ebook section of traderselfcontrol.com. Pick up these books and use them alongside with any trading system that you're doing, and that will really help you to become a successful trader. So those are the next steps. That is what I recommend that you do for the next part of your journey into becoming a successful trader, and I wish you all the best. I hope you found this short mini course a useful preparation for your trading, and I wish you the very best in your future trading career.